Hello, everyone. It's me, Eric Eichenwald, your favorite money manager with Triumph Capital Management, reporting for you Wednesday, August 19th, 2026. Let's jump into it, shall we, folks? Stocks today broke a 3-day losing streak, only barely. Each major index did close slightly higher. But take a step back. Year to date, really look at it. The Dow Jones Industrial is up a wonderful 11.23%. The S&P is up 12.60, and the tech-heavy Nasdaq is up 13.29. Hey, Joey, I got the Mots in the story of today. So the story of today, the main event, if you will, landed at 2 p.m. Eastern Standard Time with the Federal Reserve released the minutes from its July 28th and 29th meeting. Think of the FOMC meeting like a family sitting down at Thanksgiving dinner to decide one thing. And that one thing that they're looking to decide is whether to raise interest rates, cut interest rates, or leave them alone. The headline result was already in. We knew what the Federal Reserve did. The family voted 9-3 to leave rates unchanged. But the minutes that came out today is the transcript of the whole dinner conversation. And today, when it got released, we finally got to read it. Give me the tea. Here's what stood out. 3 regional Federal Reserve presidents from Cleveland, Dallas, and Minneapolis pushed for quarter-point rate hikes at the table. They warned that if we delayed any longer, this could mean steeper Federal Reserve rate hikes in the future and a more painful setting if they have to go steeper down the road. But beyond those 3, many of the other participants said that tightening would likely be unnecessary and only necessary if inflation didn't start to come down. And of course, we saw inflation come down with the economic news I reported over the last 2 weeks. Like all good stories, though, there was a big twist. While the Fed was preparing to release the minutes this morning, another member of the family, Treasury Secretary Scott Bessent, quietly slipped out and made a move on his own. This morning, listen to this. This morning, the Treasury Department announced that it will at least double the size of its long-term buybacks from $2 billion per operation to at least $4 billion per operation and double how often it runs them. That's going to start on September 9th, and it's going to run all the way through November 4th. So what does that mean in plain English? Let me unpack that, okay? When the Treasury buys back its own bonds, there are fewer bonds in the marketplace. Fewer bonds means higher prices because there's demand for treasuries, okay? And when you have a higher price on a bond like a seesaw, the yield goes down. So while the Federal Reserve sitting around that Thanksgiving table trying to decide to raise rates or not raise rates or leave them the same, and you got 3 family members going, we want to raise them, we want to raise them, the Treasury quietly walked outside and started pulling down long-term interest rates. So today, the 30-year Treasury fell by about 9 basis points, all the way down to 5.2%. It's the biggest one-day drop in over a year. Now, listen, it's a lot to unpack, but I'll give you the short version. The short version is this. The Fed and the Treasury are, in effect, pulling on different ends of the same interest rate rope. Lower term yields historically support stock prices and could help ease mortgage rates down the road, which leads me to my next topic, some of the economic news for today. So speaking of mortgage rates, here's this morning's economic data on mortgages. And this is where it gets a little bit interesting for anybody looking to buy a house, for anybody looking to refinance a loan, so on and so forth. And so think of it like this. If the Fed is the family debating the decision on what to do with interest rates, mortgage applications, which is the data we got this morning, that is the neighbors listening through the wall to figure out how nervous they should be. This morning, we got the weekly numbers. And week over week, mortgage applications fell by about 0.5%. And the weird thing is that was after last week when we saw mortgage applications rise by 3.6%. So the neighbors, home buyers, and refinancers are getting more cautious. That's what the data told us this morning. Rates have stayed high. I think at 30 years around 6.75. I think it fell to 6.72 or something today. And with the housing data that we got yesterday that I reported on, we see that stuff kind of cooling around the edges. Refinance activity didn't tick up a hair, and purchase activity continues to kind of soften. Let's switch gears. Let's talk about earnings. Today we got Target and we got Lowe's, two big retailers. Okay. And there's a divide between these two, and it tells us something. First of all, Target crushed it. Revenue was up 26.5 billion. Comparable sales were up 3.8%, and management raised full year guidance. Wall Street loves it. Lowe's on the other hand, trimmed its full year outlook. Comparable sales were up, but ever so slightly, only 0.2. And management cited soft do-it-yourself spending as the culprit. The consumer is showing up for essentials and values, but pulling back on discretionary home projects. So what's on deck? What do we got coming out? All right. So looking ahead, tomorrow, 8:30 a.m. Eastern Standard Time, we'll see weekly jobless claims. Historically, weekly jobless claims give us a real-time read on the labor market. And after the close of the market tomorrow, we get Walmart. Walmart reports second quarter earnings. Remember, Walmart is still the biggest retailer in the country. So when they weigh in tomorrow, we'll be watching and I'll be reporting. Listen, that's it from me today. Derek Eichenwald, Triumph Capital Management. If you like what you heard here, make sure you subscribe to the YouTube channel. Putting out these videos daily, weekly, monthly, yearly. Want to send out a big birthday wish to Danelle Fanning. Boom, boom. Told you I'd do it. Signing off. Y'all take care.